Welcome to our deep dive into the exciting world of real estate tax benefits. Navigating these waters can greatly enhance your investment strategy. Today we'll discuss key benefits such as depreciation, 1031 exchanges, mortgage interest deductions, and capital gains tax exclusions. Stay tuned as we unravel the first benefit, depreciation. First on our list is depreciation, a significant tax benefit for real estate investors. But what exactly is depreciation? Simply put, it's a deduction you can take each year on your taxes for the wear and tear on your property over time. It's like the government's way of acknowledging that buildings deteriorate and require upkeep. Depreciation is calculated based on the value of your property and its expected useful life. For residential properties, this is typically 27.5 years, while commercial properties are depreciated over 39 years. This means that every year for the life of this period, a portion of the property's value can be written off against your taxable income. Now let's get into the nitty-gritty of how this impacts your taxes. Suppose you've bought an investment property worth $200,000, excluding the land value. If this is a residential property, you would divide this value by 27.5 years, giving you an annual depreciation of about $7,200. Here's where the magic happens. This $7,200 is subtracted from your taxable income. So, if you're in the 25% tax bracket, that could mean a tax savings of about $1,800 annually. Over the course of 27.5 years, that's a whopping total of $49,500 in tax savings. But remember, depreciation isn't a one-size-fits-all strategy. It's always best to consult with a tax advisor to understand how this benefit applies to your specific situation. So there you have it. Depreciation is a major tax perk for real estate investors. It's like a slow, steady stream of tax savings flowing into your pocket year after year. It's not just about the income properties generate, but also the tax benefits they offer that can significantly impact your bottom line. Depreciation is indeed a powerful tool for investors. Now let's dive into the 1031 exchange. The 1031 exchange, a fantastic way to defer taxes on real estate investments. Now, if you're wondering what a 1031 exchange is, allow me to clarify. Named after Section 1031 of the U.S. Internal Revenue Code, it's a method that allows you to postpone paying capital gains taxes when you sell a property, as long as you reinvest the proceeds into another, like-kind property. Here's a simple example. Let's say you bought a property a few years ago for $100,000. It's done well and now it's worth $200,000. If you were to sell it, you'd owe capital gains tax on the $100,000 gain, but with a 1031 exchange, you can use all of that money to buy another property and defer the taxes. The beauty of this strategy is that it allows you to keep your money working for you. Instead of paying a hefty tax bill, you're reinvesting and growing your wealth. And the best part, you can keep doing this over and over again, effectively deferring your tax indefinitely. Now, it's not just a simple sell and buy process. There are very specific rules to follow. For instance, you have a 45-day window to identify potential replacement properties after you sell your initial property. And you must complete the purchase within 180 days. And remember, the replacement property must be like-kind. But don't let that term scare you, it's quite broad. It doesn't mean you have to buy the exact same type of property. You could sell a condo and buy an office building, or sell a single-family home and buy a retail strip mall. It's all about the investment purpose, not the type. A 1031 exchange is not a loophole, but a provision in the tax code designed to encourage reinvestment and growth. However, it's crucial to consult with a tax advisor or real estate professional before making any decisions. A 1031 exchange, a savvy strategy to keep more of your investment working for you. Next, we explore mortgage interest deductions. Mortgage interest deductions, another great way to lower your tax bill. Now, let's dive into mortgage interest deductions. This is a tax benefit that can significantly reduce your tax liabilities. But what exactly is a mortgage interest deduction? Well, it's a type of deduction that allows you to subtract the amount of interest you've paid on your mortgage over the tax year from your taxable income. For example, let's say you have a mortgage on a rental property and you've paid $10,000 in interest over the course of a year. With the mortgage interest deduction, that $10,000 can be deducted from your taxable income, potentially moving you into a lower tax bracket. But how do you qualify for this deduction? You must meet 3 conditions. First, you must file a Form 1040 and itemize your deductions. Second, The mortgage must be a secured debt on a qualified home, which means the property must be your main home or second home. Finally, you must have taken out the mortgage to buy, build, or substantially improve your home. Now let's talk numbers. According to the National Association of Realtors, nearly 30 million homeowners claimed mortgage interest deductions on their tax returns in 2022, with a total deduction amount of nearly $60 billion. This goes to show how widespread and significant this tax benefit is for homeowners and real estate investors. It's also worth noting that the Tax Cuts and Jobs Act of 2017 placed a limit on the amount of mortgage interest you can deduct. For mortgages taken out after December 15, 2017, you can only deduct the interest on up to $750,000 of qualified residence loans. Mortgage interest deductions, a boon to homeowners and investors alike. Let's move on to our final key benefit, capital gains tax exclusions. Our final stop today is capital gains tax exclusions, a way to keep more of your profit. Let's dive right in. Capital gains tax exclusions is like a secret weapon for real estate investors. It's a tax benefit that allows you to exclude up to $250,000 in profit from the sale of your main home from your taxable income, or up to $500,000 if you're married and filing jointly. To qualify, there are three main criteria. First, you must have owned the property for at least 2 years. Second, you must have lived in the house as your primary residence for at least 2 of the last 5 years. And third, you cannot have excluded the gain from the sale of another home during the 2-year period before the sale of your current home. Now let's illustrate this with an example. Suppose you bought a house for $300,000 and lived in it for 2 years. After those 2 years, you sell the house for $600,000. That's a cool profit of $300,000. If you're a single filer, you can exclude up to $250,000 of that profit from your taxable income. So instead of paying capital gains tax on $300,000, you're only paying on $50,000. If you're married and filing jointly, it gets even better. You can exclude up to $500,000 of profit. That means you can pocket the entire $300,000 without owing a penny in capital gains tax. That's a lot of money saved, money that can be reinvested into your next property or used to fund that dream vacation or whatever your heart desires. This is the beauty of capital gains tax exclusions. It's a tool designed to help you retain more of your hard-earned profit. Remember, tax laws can be complex and change frequently. It's always a good idea to consult with a tax professional to understand how these laws apply to your specific situation. Capital gains tax exclusions, ensuring you enjoy more of your hard-earned profits. So, there we have it, a journey through the major tax benefits of real estate investing. We've navigated through a labyrinth of tax codes and regulations, shedding light on the many ways that investing in real estate can be a boon to your financial portfolio. Let's take a moment to revisit the key points we've discussed. Firstly, depreciation. The IRS allows investors to deduct a portion of the cost of a property over its useful life, a significant boon that can offset rental income and lower your overall tax bill. Secondly, we discussed the power of 1031 exchanges. Named after Section 1031 of the IRS Code, this allows investors to defer capital gains taxes when they sell a property, as long as they reinvest the profits in a like-kind property. A potent tool, it helps you grow your real estate portfolio and your wealth, tax-deferred. Next, we delved into mortgage interest deductions. If you have a mortgage on your rental property, the interest you pay can be deducted from your taxable income, further reducing your tax liability. Lastly, we explored the capital gains tax exclusions. If you live in a property for 2 out of 5 years before selling it, you may exclude up to $250,000 of profit if you're single, or up to $500,000 if you're married, filing jointly. Understanding these benefits is integral to successful real estate investing. It's not just about buying and selling properties, but also about strategically leveraging tax benefits to maximize your profits and build wealth over time. Thanks for joining us on this journey through real estate tax benefits. Remember to subscribe for more insights on building wealth through smart investing.